Well, here we are. It's another podcast day, and the hot topic that we're here to talk about, Haley, is with our go-to kind of loan depot lender, Jason Osenton. Thank you, Jason, for stepping in here today. Much appreciated. Rates are going up, and people are starting to get worried. Some people are thinking maybe we've missed the boat. And what is, because that in itself can create, there are ways to work around these things, and kind of what are some of the creative ways we can look at, rather than saying, oh my gosh, rates are going up. How can a buyer turn around and be like, hey, you know what, there might be an opportunity here for me?
Yeah, good question. Rates have gone up, and it was inevitable. We knew they were going to go up. We didn't anticipate them going up as quickly as they have, but they have, and it's the reality. So we have to get flexible sometimes and get creative. And first of all, if you're considering, yep.
Well, to give people a little bit of a sense, we're at the end of March. We're at the end of the first Q in 2022, and in this quarter, they've gone up by almost, on the fixed end, they've gone up by 1%, right?
Yeah, at least. It depends on, every scenario is different. So there's not one rate that works for everyone. So we have to figure out your specific scenario, their client scenario, and then rates have increased anywhere from a full percent to even more, depending on the situation. So they've moved up pretty quickly in just the last couple months.
Okay. So, and then what about, in the past, the arms were the most common. Not to show my age, but almost 20 years ago, everybody did an arm. And then the financial crisis made people terrified of arms because of a particular product within the arm field, because a loan is either a fixed, fully fixed for the entire term, or it's an arm. On the arm scenario, there, it became a dirty word, but it's not a bad product, and there is some play there. Can you kind of shed some light on how somebody could use a 5, 7, or 10-year fixed arm?
Yeah, great question. So ARMs did get a bad rap in the financial crisis. And it was more so the option ARMs, or really negative amortized loans, which you're paying much less than what the actual rate is. So your principal is growing. And then when values dropped, you had this inverse relationship, and everyone that didn't have any skin in the game were well below their values and walked away from properties. So that created a snowball effect.
And you can't even get those loans anymore.
No,
they're not in existence.
Yeah, you can't get negative amortized loans. So that kind of gave the whole ARM world a bad rap and a bad name. ARMs are actually great products, but they're specific for some people. Some people it's not good for, some people it's great for. So you really have to figure out your client and figure out what their needs are and their goals are, so we can match to those needs. Now the ARMs, they're yes, you're right. As you said, the fixed rates are fixed for the full term. They're amortized over that term, so you know exactly what you're getting. The ARMs are a little bit more flexible, a little bit, there's some risk versus reward there, where like a 5-year ARM is going to be fixed for 5 years, even though it's a 30-year loan. And the 7-year ARM fixed for 7 years, and same with a 10-year. So you have some options there to consider. And of course, the lower the fixed period, the lower the rate. So there's the risk versus reward there. Now, the 5-year ARM is typically harder to qualify actually than the 7 and 10, because the 5-year ARM is a riskier product. So they normally add like a 2% rate to the initial note rate to qualify you, as opposed to the 7 and 10-year ARM, depending on the investor, they will a lot of times qualify you on the actual note rate. So
which would make it easier to qualify than on the 30-year rate.
Exactly. Okay. So with rates increases your payments, the monthly payments, which increase your debt ratios. So if your debt ratios are already tight on a loan scenario and you're already at the max, then you definitely have to get a little bit more flexible. One way to do is consider an ARM. like a 7 and 10 year ARMs are really popular right now because they have lower rates. And you know what? We are thinking that there could be a recession down the road here soon. So with that, normally a recession brings lower rates. So we're telling most of our clients and instructing them that, hey, maybe consider an ARM and be ready to refinance down the road. So there's some, you're not buckled in or married to a product even if you close on that one. We can always
Totally.
refinance it.
Well, and we've seen people over the last number of years with the, rates have fluctuated a little bit in that period, and they're on a 30-year fixed and they refi a 30-year fixed. And it's like, the thing about having a 30-year fixed is you're supposed to be one and done. And people, and you're paying a higher rate on the 30-year loan if you're then eventually going to go and refi it at this other point.
Right.
So that, and then what it has gone up before the average age of a loan was 5 to 7 years. Has that increased, or is it still that kind of period, or has this refi boom that we've kind of gone through brought that number down?
Well, it's probably brought that down because everyone has refinanced multiple times over the course of the last decade plus. But the average first-time home buyer is normally about 7-year period. So that's another reason to consider an ARM, especially if you're a first-time home buyer and you're maybe looking at a property that you're going to outgrow, you're going to need to upgrade, whatever that might be. And it's not always about being in the property. You don't have to always look at, okay, I'm only going to be in the property 10 years. But you have to also consider, am I going to need to refinance this property in 5 years, 7 years, whenever that is? So if you need to pull some cash out for tuition, home improvements, anything for the family, whatever it might be, then ARM is a really good option to at least consider.
Okay, cool. What are your thoughts, Hayley? Kind of seeing on the front lines out there with
I think it's just really important to like stress Jason's last point about how long, not only how long you plan to have the property, but, I think that people forget about the things like you just said, tuition and, buying another property or whatever you're going to do within that time frame. An ARM could really make sense. And I think that there's like a lot of general kind of just misunderstanding of like how mortgages work generally, especially among millennials and first-time home buyers. And there is a sort of a cloud of like ARMs being a scary word, right? From when we were growing up and we saw what happened. So I think just like remembering also, like, aren't we the only country that has 30-year fixed mortgages? Like, isn't that really unusual? Yeah. And
it's the only country in the world. If you go to Europe or
I think that like
the Middle East, you're not getting it. So,
there's this kind of like safety net feeling like, oh, I need to like default into that. And, like that's just not necessarily the case. So what are you telling Jason, just like, people coming to you? If actually, I do have a question for you in terms of if somebody's like, I'm freaking out, I'm making offers, but like, I can't, it's just so competitive what I'm looking at. Can I lock my rate now?
Yep. Well, that's a good question. So normally you're not going to lock a rate until you get into contract. It depends on your loan scenario, but we at Loan Depot have a program called Lock and Shop, where unfortunately it's only available on conforming loans right now, which go up to about just over $900,000. But for the rest of us, jumbo loans, normally you're not going to lock a rate until you get into contract. Now, what I'm telling them is, rates are going to be what they are. Just focus on getting into contract, and we can always refinance that later if a recession hits and the rates go down. So we'll manage that to make sure of that. But right now, you can't really worry about rates. Now, the people that are close on the edge with those, let's say, debt to income ratio thresholds and a higher rate means they can't get the property they want to get, then you have to get a little bit more flexible. And you got to make sure they're working with a flexible lender as well. Most lenders have a max debt to income ratio of 43%, and you can't go over that limit. We actually have jumbo options as high as 55%. So that gives a lot of more flexibility in this type of market. and a little bit more breathing room for those higher debt ratio buyers.
That's cool. For the lock and shop scenario, if I had a really large down payment, and I was going to be able to keep my lending at 900,
Yeah.
if I were to choose the lock and shop option, how long is it locked for? Is it a 45-day thing?
It's a 90-day lock,
90
and
day?
can be extended, but it's a 90-day lock. And then if you don't find a property in that 90 days, we can start it over from there. It's hard to say with the volatility in this market, whether that's a good choice or not, but it gives you a little bit more security.
Yeah. And you locked, let's say, just out of curiosity, when you get a property in the contract and the rate has actually dropped below where you have it locked, are you stuck with the lock, or?
No, that's what's the nice part. There's actually a float down policy as well. So once you're in contract, if the rates drop more than 0.25%, you can float down.
You can float down. Sweet. Because it is quite volatile right now. It's popped up and down quite a bit.
Amazing. Yeah.
Yeah, it's amazing. So
what I'm taking away from this conversation is I just heard you say buyers should not be worrying about rates right now. They should worry about getting into contract and then probably have the ability to refinance later.
I just think you can't really worry about what's not in your control. You have to be worried about what you can control. And as a buyer, the only thing you can really control is making offers and getting out there, testing the waters, really feeling it out and putting your best foot forward. Because right now in this competitive market, you have to be top of the market, and rates are going to be where they're going to be. And again, with all the volatility, we're going to probably see lower rates at some point in the near future. It's not guaranteed, but if you're comfortable, you can handle the rates where they're at right now. I mean, we're still at historically low rates, so it's not like it's a big margin between where we were at a couple months ago, but there's still amazing low rates. So we have to keep that in our mind as well.
Cool. So, and kind of the one thing of working together over these years is creativity is the way to kind of bring it together, right? Because there's no point in worrying about higher rates if you don't have a property in contract. When you have a property in contract that you can actually buy, we have ways that are creative to make it work, right? And do the right thing for what a buyer is looking to do. And every buyer is going to have different needs, and there's a way to figure out how to do that.
Yeah, and along with that creativity, we have some great tools, including a buy versus rent tool, a bid over ask, a cost of waiting tool, debt consolidation, a few more that kind of help the buyers figure out, is it worth it to buy this property versus this property, and should I wait, or what their goals are, and match those.
I think we should definitely provide a link to the cost of waiting in our posting here. Yeah,
in the comments. Can you, is there a way we can have a link to add that in?
That's a tool that we have at our company. So it would be a link to myself.
It'll be a link to you. How do we find you? How do we find out? What's the link to Jason?
I'll give you that link.
Yeah.
Just for you.
All right, Jason, if people want to reach out to you, how do they do that directly?
My email, Osenton, that's JOSENTON @loandepot.com, and my phone number 415-524-8695.
Awesome.
Fantastic. Awesome. It's been great chatting. Thank you. Cheers.
Thanks.
Thank you.